Welcome to another lesson on Shinomi, and today we'll be covering an introduction to stocks. First, with a short explanation, stocks represent ownership in a company. When you buy a stock, you become a shareholder, which means you own a small part of that company. Stocks are one of the most common ways people choose to invest their money to build wealth over time. So what exactly are stocks? A stock is a share of ownership in a company, and companies choose to issue stocks in order to raise money for growth or new projects. Third, stocks may earn money through dividends, which is a portion of company profits. And stock prices can rise or fall based on a company's performance and market conditions. Now that we've covered what stocks exactly are, let's learn why people choose to buy stocks. There are many reasons, but I'll explain 4 main reasons that may motivate the purchasing of stocks. First, it is to grow their money through capital gains, which is when stock prices increase. It is also to earn dividends from profitable companies and gain return from their stock purchases. It also helps them become partial owners of companies that they believe will grow and succeed. And last, it helps them build long-term wealth for future goals like retirement or education. Now, how do these stocks work and how do you get money back from purchasing something? You may have been exposed to a brief introduction or explanation to how stocks work, but more specifically, stocks are traded on a stock exchange like the New York Stock Exchange. Investors buy and sell stocks through brokerage accounts, and stock prices change on the daily, which is based on supply and demand. And lastly, the value of a company or market capitalization equals its stock price multiplied by the number of shares. Right now, the idea of buying something and earning more money back from it sounds too good to be true. And in fact, it kind of is, because there are also risks along with the rewards you earn from buying stocks. First, stocks can offer high returns over time, but that also comes with a higher risk than saving accounts or bonds. Prices are often affected by company news, economic changes, or global effects. So in order to mitigate this, diversifying your investments or owning many different types of stocks can help you reduce risk. There are also some key terms that are worth going over. First, we have shareholder, which is someone who owns a share of a stock in a company. A dividend is a payment made by a company to its shareholding from profits, and capital gain is the profit made from selling a stock at a higher price. A stock market is the place where stocks are bought and sold. And lastly, portfolio refers to a collection of all the investments a person owns. Moving on, we've now covered all of the content, and let's go over the key takeaways. From this lesson, I hope you learned that stocks is an essential part of the financial world. Understanding how they work greatly helps individuals make informed decisions about saving and investing. And though stocks can be risky, learning to invest wisely can lead to long-term financial success. Thank you for watching another lesson on Shinomi, and stay tuned for